Hey, what is going on? Happy Tuesday to all of you out there in interwebs land. Welcome to SRT Live with me, your host, Sean Richard, and I appreciate you joining me today. Today's going to be an exciting day. We've got a lot of information that we need to cover from last week. It was an action-packed week, and we've doubled up on that. This week is a pretty action-packed week as well. We've got some heavy hitters tomorrow and Friday that we'll get into as well. So without further ado, let's dive in. Let's start with last week, and let's talk about everything that got thrown at us last week. And it was a busy week. So as always, last Thursday, we got jobless claims, and that's unemployment claims. We got initial claims, which are people filing up for unemployment for the first time. And we got continuing claims, people renewing their unemployment claims. And so this information tells us how strong the labor market is. So do we have very low unemployment claim numbers, or are we running hot with high unemployment claim numbers? And so last week we ended up with 180,000 new claims filed versus the previous week was 185. So we are on the decline. We are at post-pandemic low levels. These are super low levels that we're seeing post-pandemic, and they're continuing to shrink. So very healthy labor market, right in line with expectations, that 180,000 that we got last week. Continuing claims came in at 1.408 million for the week, and that's also right in line with expectations. To tick up from what the market was expecting, but relatively right in line. This is compared with last month, 1.409. So we were pretty much neck and neck from the previous week to last week. So those are our jobless claims. We have the National Association of Realtors come out with their pending home sales data. So this measures contracts on existing homes. So these aren't closed sales just yet, but these are contracts or pending home sales. And so for the month, this was actually down 1.2% versus an expectation of down 1.6%, and that's relevant. You know, we are down in contracts, but as I'll get into in a minute, I really do think that really speaks to what's going on with inventory. We're very tight on inventory, so a little bit of reduction there, but we can't sell what we don't have. All right. Some headline numbers. All right, get this. We had GDP reading last week, and GDP. Now let's go back, and I'll talk more about this in a minute. But GDP fourth quarter last year, fourth quarter GDP growth of 6.9% for the fourth quarter. Growth of 6.9%. Q1 expectations for the market were growth of 1.1%. What we actually got was negative 1.4% GDP. We got a contraction of GDP. So what does that mean? Well, if you're a student of economics, you know that the technical definition of a recession is 2 consecutive quarters of negative GDP. And so we have our negative 1.4 for Q1. And so we need to keep an eye on that. If Q2 shows a negative GDP as well, then technically we've been in a recession and didn't necessarily realize it. So GDP, very important to watch. We also got the Fed's favorite measure of inflation, PCE, which is personal consumption expenditure. And so this measures inflation at the consumer level. It actually strips out rent and housing costs. So this is the Fed's favorite measure, but to be honest with you, with everything that's going on in the housing market, increases in home prices, increases in interest rates, an inflationary measure that doesn't take into consideration the largest expense that you have is in my opinion, not quite as accurate. But this is the Fed's favorite measure, and I am not the Fed, so it's okay. But PCE, personal consumption expenditure, we got month-over-month numbers and we got year-over-year numbers. And so here's the bottom line. We're seeing an increase in inflation. We've been seeing it all year so far. On a month-over-month, we actually got a 0.9% increase versus the market's expectation of a 0.5%. So a big jump up there. And then year over year, we actually hit pretty much right on the mark of what the market was expecting. The market was looking for 6.5% year over year inflation, and we're at 6.6. Now, that looks like, okay, right in line with what the market was looking for. However, from the previous month, that 6.6 was up from 6.3%. So we've ticked up a little bit on a year over year basis from where we were last month. So inflation looks to still be rising. We've got another inflationary report that's going to be coming up in May, the CPI, Consumer Price Index. And that's, in my opinion, a little bit more accurate because it does take into consideration housing. So once that hits the newsstands, we'll cover that as well. So obviously a massive week last week, all kinds of data. We've got another one this week as well. So yesterday and today, pretty light news week. There were a couple of items that came out, but nothing that was really market moving. So let's look ahead to later this week. So tomorrow, Wednesday, we get the ADP payroll report, which is the precursor to Friday's jobs report, national jobs report from the Board of Labor and Statistics. Also tomorrow, and probably more important, is the Federal Open Market Committee is actually finishing up their meeting, and we're going to hear their interest rate decision for the Fed funds rate, and we're going to hear Jerome Powell. He's going to be talking as well, Fed Chair Jerome Powell. And so the market is expecting that the Fed is going to increase the Fed funds rate by 0.5%. And that's going to impact any variable rate products like credit cards, home equity lines of credit, things of that nature. The Fed funds rate is short-term lending. And so it does not have a direct impact on mortgage rates. Now, in an ideal world, increasing the Fed funds rate is designed to help combat inflation, bring inflation down, and inflation coming down would actually help interest rates. So a little bit counterintuitive, you have the Fed increasing the Fed funds rate, which would in turn, or should in turn, bring down mortgage rates indirectly. So we want to keep an eye on that and see what they actually pull the trigger on as far as an increase. 0.5%'s the consensus, but there's been rumors that it could be a little bit more than that. I think the negative GDP reading kind of put the kibosh on any increase larger than 0.5%, but we're going to have that information tomorrow, so we want to keep an eye on that. On Thursday, as always, we get jobless claims, both initial and continuing. So we'll look at that to see where we are as far as the strength of the labor markets. And then, as I mentioned, Friday, we get the Board of Labor and Statistics National Jobs Report. We also get the unemployment rate reading, which that's expected to tick down a tiny bit from 3.6 to 3.5%. So we're going to keep an eye on that as well. All right, so that's what's coming up this week. Now, what do we want to watch? What do we want to focus on? And so as we move forward, 3 things that I want to talk to you about today that we want to have a close eye on. Number 1 is the Fed. Obviously, we've got their Fed rate decision, and we're going to see where they come out with the increase to the Fed funds rate. That's going to be a market mover. The second part of the Fed, though, is going to be what they say about their plans to run off their balance sheet. And so, Sean, what does running off their balance sheet mean? Well, if you've listened to me before, then you've heard me talk about this. But essentially, what I mean by Fed running off their balance sheet is the Fed has been investing in bonds and treasuries for quite some time now. Quantitative tightening. And with those investments, they've been accumulating treasuries and bonds. And if they decide to start running off their balance sheet, that means they're going to start selling without reinvesting. And that has the potential to have some negative impact on interest rates, on mortgage rates. Because if they start selling larger volumes of mortgage bonds, mortgage-backed securities, which do have a direct impact on mortgage interest rates, then that could push interest rates a little bit higher. So we have some conflicting information. We've got the Fed looking to increase the Fed funds rate, which ideally should help mortgage rates. But then on the other hand, we've got the Fed possibly looking at running off their balance sheet, which could push interest rates higher. So it's going to be very, very interesting to see what the Fed says and what Jerome Powell says about any plans to run off their balance sheet with bonds and treasuries. So keep an eye out for that. If you watch the press conference with Jerome Powell, pay close attention to anything that he says about the potential runoff of the balance sheet. All right. Second thing that we want to focus on right now and look for is inventory and existing home sales. So inventory is at exceptionally low levels. The National Association of Realtors in March said that 950,000 homes for sale. If we compare that to March of 2007, way back before the crash, we had 3.7 million homes for sale March of 2007. So fast forward 15 years, we are below 25% of where we were just 15 short years ago. And we are also several 100,000 below where we were this time last year. So inventory continues to shrink. We want to keep an eye on that. We can't sell what we don't have. And if inventory continues to stay low, which is expected, and demand continues to stay high, which is expected, we're going to continue to see home prices rise. So great news for all of you home buyers out there that are not quite sure if it makes sense to still purchase a home in this market. You're still looking at getting some phenomenal appreciation in your house. So that's really good. All right. And then the existing home sales. So in March, the annualized rate of sale for the whole year, 5.77 million. And again, this is also from the National Association of Realtors. So that is actually down 2.7% from February's annualized reading. And it's down 4.5% year over year. But again, I hearken back to the fact that we are not able to sell what we don't have. If there were more homes on the market, more homes would be sold. And that, I think, has the biggest impact on what the media is spinning into a negative and saying, oh, the housing market's not looking good. We've got a decrease in existing home sales. Well, we do have less homes being sold, but we also have a lot less homes available for sale as well. And I think that plays the biggest role. So watching inventory as we move forward is going to be an important part of where the housing market's headed. Low inventory, high demand, home prices are going to continue to rise. And then third thing that I want to talk to you about and for us to look at going forward is going to be the jobs report from Board of Labor and Statistics on Friday. The employment market is very robust right now. We've got a significant amount of job openings. We've got post-pandemic lows on unemployment claims. So looking at that jobs report and seeing where we end up to show the strength of the labor market, what I think we need to watch for is if we get a surprise reading on that. If for some reason we see the jobs report significantly miss to the downside, if we're just not creating as many jobs as expected. And similar to the real estate, the homes, the existing home sales, you know, we can't sell what we don't have. Well, we can't fill positions if we don't have enough workers that need those positions. So I think we could see a little bit of surprise. I don't know if it's going to be a massive miss, but I think we could see a little bit of surprise with the BLS jobs report on Friday. So we want to watch for those three things: the Fed tomorrow, inventory and existing home sales as we move forward, and then the Board of Labor and Statistics national jobs report on Friday. Well, ladies and gentlemen, that is all I have for you today. Thank you for joining me for another edition of SRT Live. Again, I am your host, Sean Richard. If there's any questions that I can answer for you about any of the information today, don't hesitate to reach out. You've got my contact information here. Feel free to comment in the posts or post in the comments below. And if my team and I can help you with any of your clients, if you're a real estate agent, if we can help you purchase or refinance, if you're a home buyer or homeowner, we want to be the resource and the go-to to make sure that you've got an exceptional experience for all of your home lending needs. So thank you so much for joining me. Have an incredible rest of your week. Take care.